Welcome everyone to Daily Rates Live with the Mortgage Calculator. Give it a few minutes here while we get connected on all the different platforms. Good morning to everybody commenting already. If you have any questions about the show today, please drop it in the comments and we'll be sure to get to it. And today's topic will be interest-only loans. So a pretty cool option we can add to pretty much all of our non-QM programs as a feature. So just give it a few more minutes. Thanks everybody for being early. And good morning to everybody out there. All right, looks like we're up and running. Let me go ahead and get started. As I said before, please drop a comment in there while you're tuning in. And then if you have any questions, please throw them in the comment section on whatever platform you're watching on. We are live on YouTube, Facebook, Instagram, Twitter, or X, all of the different platforms. So please drop a comment in there if you have a question. Let's go ahead and get started today. My name is Nick Hershey. I am the president of the Mortgage Calculator. We are a lender that specializes in non-QM loans with over 5,000 unique loan products, including our topic for today, which is going to be interest-only loans. So I will go through the live rates and the live market for all of our general programs here, as we do every morning. And then we'll have Jose Gonzalez, our sales manager with 28 years of experience, go over our unique interest-only loan options. So without further ado, let me change my screen and we'll check out the general markets today. And let me pull up the pricing tool here. So this is our pricing tool for our team. This will show us the general rates and the APR for today. It is February 28th, just after 11 a.m. Eastern. So all of our standard programs have our live rates issued here. So we'll go ahead and set up a basic scenario to compare across the programs. If you'd like a full breakdown of all of the fees, the itemized fees that go into the APR, a full loan estimate, please get with one of our team members. We have over 300 licensed loan officers. So for the demos, as we do every day, we'll set up a basic scenario. We'll set a loan amount of $400,000. We'll set the LTV to 80% loan, 20% down payment. Oh, whoops. Let me reload this page here. There we go. Get my special version, sorry. So 400,000 loan amount, 80% loan to value, and we'll ask the computer to find the lowest rates we can offer for conforming conventional first, and we'll compare that to FHA, which is usually the second option most borrowers look at. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional programs beyond the standard here. We also offer VA and USDA. VA is only for our eligible vets and active service members. If you are, just let us know. And we did do an episode on that the other day if you want to check out the programs we have. And USDA is only for eligible properties. If you are looking in those areas, just let us know. And we did do a show on that last week as well if you want to check out all the different programs we have. We'll start today with conforming conventional, purchase, 30-year fixed, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos here, we'll use a credit score of 760 and an estimated debt to income ratio here of 40. So with these settings, let's see what we're looking at this morning. And about the same as yesterday, not much down or up, pretty stagnant in the market. So 6.624 rate, 2.125 discount points of cost, final APR of 6.89, pretty much the same as we were yesterday. So a good option for our customers looking for conventional. It's definitely going to continue to hopefully trend downward overall. Now, if for any reason our customer doesn't qualify for conventional, we'll set up the same exact scenario here and compare that with an FHA option. FHA does allow a little more leniency on credit events as well as a much higher debt to income ratio, but we'll keep everything identical so we can compare across the programs and actually compare the APRs here side by side. So this jumped up a little bit from where it was yesterday, 5.875 rate, 2.125 discount points and cost, puts the final APR at 791, so just a touch under conventional here for our FHA options. So our customers that qualify for both, definitely take a look. And our customers that need to use these FHA programs, this APR does include the upfront and yearly mortgage insurance. So this is a great option as it is very comparable to conventional. Now, where we love to specialize is, unfortunately, if our customer doesn't qualify for either program, many other banks or lenders have to deny that customer. But that's where we love to present our 5,000 additional options here under expanded guidelines, also known as non-QM. So when we select this option, everything else will stay the same, but now we have a new box that pops up where we can change the income type. So full doc is what we use for FHA and conventional. That's 2 years of tax returns. So if our customer doesn't qualify with 2 years of tax returns, we'll use one of these other options. We have asset-related options, business bank statement options, the investor programs are just for investment properties. We'll pull that up shortly. Personal bank statement 12-month is what we use for the demo here. That's the most popular for primary home. We also have RSU, stated income, VOE, 1099, P&L, and no income CDFI. For the demo, we always use the most popular program here, the 12-month bank statement, and that's for our self-employed borrowers. Many times it's our self-employed borrowers when they submit 2 years of tax returns, may have various write-offs and not qualify at all, or just may need a little bit of extra income. Either way, we solve the problem with no tax returns at all, just their last 12 bank statements to determine a debt-to-income ratio of 40% in our example here, using just their cash in the bank. So many times our customers that are self-employed will qualify for much more income using this method. So let's check out the non-QM options. And as usual, non-QM doesn't change daily or hourly like the conventional stuff does. So pretty much the same as it has been the last few shows, 7% rate, 2.35 discount points for a final APR of 7.403. So some good options here for a bank statement option within about a half a point of conventional, which is always amazing. So our customers that need to use these programs, don't be afraid. They're only a slight bit higher rate cost there and allow us to qualify where you would otherwise not qualify. So please get with our team to find the best options. Some of these down here on the list, there's hundreds of variations. Some of these further down may allow credit events such as foreclosures and bankruptcies and other events that would cause us to not qualify. And some may allow different ways to calculate the income. So please get with our team to find the best options for you. And for our final couple demos here, we want to run some live pricing for investment properties. So we'll set up the same scenario, 400,000 loan amount, 80% loan to value, 20% down payment. And we'll have the computer find the lowest rates we can offer for conforming conventional, and we'll compare that with our non-QM expanded guideline options. Remember, government programs don't work for investment properties, so no FHA, VA, or USDA here. We'll stick with these top two. We'll start with conforming conventional. Everything will stay the same as all our demos. The only thing we've changed here is the occupancy. So let's check this out. And as I say every day for the last couple weeks, the rates go a little bit higher, you see this portfolio option pop up, which is not a true conventional option. This is one that doesn't get sold to Fannie or Freddie. So the option, the bank that's basically holding this, allows us to not have the loan level price adjustment. So you see this option with no loan level price adjustments at 6.875 rate for 3.25 discount points at cost for final APR of 7.264. And the first true conventional, Fannie Mae, Freddie Mac, either or, is at 7.125 rate for 3.25 discount points and cost, puts that final APR at 7.522, and that includes all the conventional loan level price adjustments. So good options here, but I definitely recommend our customers check out these unique portfolio options, as well as our final demo here, our non-QM options. So we'll set up, the same scenario, investment property, and this time we'll select expanded guidelines, also known as non-QM. And everything will stay the same, but now we have to select our income type. So the most popular income type for investment properties is our CR option because it doesn't require any income or employment or documentation from our borrower. We simply use the estimated rental income from the appraisal to determine a DSCR value. If the estimated rents can cover the expenses, aka the property cash flows, that's a ratio of 1 or higher. We even have options for ratios under 1, but for the demo, we'll put 1.5 so we can see all the programs. And finally, prepayment penalty must be selected. 3 years is standard, so that's what we always choose to show the most options. There are some programs that allow zero prepay that will cost more and limit the programs. And there are some programs that allow 5 years that will limit what shows up, but does save our customers some money. 3 years is standard. That's what we use for the demo. So we can see the most common options. And again, absolutely smoking. 6.75 rate, 3.025 discount points of cost. Final APR 7.216 for a DSCR option, beating the portfolio full doc and beating the true conventional. Absolutely amazing. I would say 100% of investors will take this option over any other option right now. So definitely make sure you present all these options to your investors. And if we scroll down here, there's hundreds of variations of DSCR. Some of these may allow bankruptcies, foreclosures, other credit issues. Some of these may allow us to use different ways to calculate DSCR values, like short-term rental income. And some of these may allow us to add different adjustments, such as our topic for today, which is, drumroll, interest-only loans. So our DSCR options and most of our non-QM options do allow various adjustments. That's where we get our thousands of programs, right? Because there's basically 100 basic programs, but then there's all kinds of add-ons to these programs, such as interest-only. So almost every non-QM and almost every DSCR program either has a 30-year interest-only or 40-year interest-only option that we can select that typically costs more, right? Because this is a risky feature, right, Jose? So the cost will typically be a little more, but I can't do that on the live pricer, right? This is a little complicated. The live pricer doesn't really have the interest-only options. So Jose has some very specific examples of times where we want to use this, especially for our investors out there, and even sometimes for some specific use cases on other deals. So Jose, if you're ready, let's check out some actual examples where we can use interest-only features.
Good morning, everybody. Thank you for joining us for Daily Rate Slide with the Mortgage Calculator. Interest-only loans are a great tool, especially if your borrower is barely squeaking into the qualification. For the price, we do have interest-only options that will actually qualify you on the interest-only payment. Now, you must be aware not every guideline allows you to qualify the borrower for the interest only payment just because it's an interest only loan. So I do strongly suggest that you review the guidelines for whatever option you're selecting for the loan to make sure that it fits the need. Because if you need to qualify the borrower on the interest only payment, you obviously want to make sure that the interest only payment is what will be used to qualify the borrower. Also wanted to note that the interest only option is only available for non-QM. It is not an option for agency loans. Agency loans are always going to be fully amortizing, right? So let me go ahead and share my options with you today. I have a whole slew of different interest only options that are possible. So our first option here is for a full doc loan using traditional methods to qualify the borrower, pay stubs, W-2s, tax returns, whatever may be the scenario, uh, whether they're self-employed or whether they're salaried or hourly, but we are using traditional income documentation to qualify this borrower, but we are going with a 30-year amortization on this interest-only option, where the loan is interest only for the first 10 years. And then at the end of the 10th year, it does become a fully amortizing 20-year loan. That's how the interest only loans work. So in some cases, your borrower may want to refi before it starts to become a 20-year loan. Chances are, if they go with the interest only option, they're already aware that after the 10th year, at least if you've done your job properly, that after the 10th year, it becomes a fully amortizing loan. And the game plan is usually to refinance or sell the property before that moment comes. So here, good options here. You're looking at 10.375 as your lowest cost option and 8.875 as your lowest rate option. And as I always like to note during this presentation, uh, in in the interest rates that we give you, we are assuming that we are not receiving any bona fide discount points, which would affect our compliance test, right? So here I'm showing you the rates that would be able to pass a compliance test. However, if, for example, the seller in this transaction is giving a seller credit and paying some fees for the buyer, you could apply that seller credit towards the loan discount, and any amount paid by the seller would not get counted towards your compliance test. So then you could buy this rate down even more. Our next option is our bank statement option for our self-employed borrowers. Again, we're looking at 10.375 here, being our lowest cost option, is a little bit more expensive than our full doc option, and you can buy that down to 9.25%. And another option here is our profit and loss option. Again, bank statement and profit and loss options are for self-employed borrowers only. So here, lowest cost option is 10.375%, and our lowest rate option is 9.125%. And now for our asset utilization option. Now, you will note the other options did allow you to go up to a 90% max LTV, as you can see right here, 90% LTV. Never any mortgage insurance charged on any non-QM loan when you are above 80% LTV. But in this case, asset utilization is not as deeply embraced product as bank statements, for example. So you will note that the LTV max here is 80% as opposed to 90%. But you will also note that the rates are also amazing due to the fact that we are at 80%, which is a more traditional or standard, should we say, loan to value in the non-QM world. So here, our lowest cost option is 8.25% with a little bit of a lender credit. And you can buy that down all the way to 7.375, which is an amazing rate, at a cost of 2.5 points. Now, another of our self-employed options here is the 1099. And in this case, I'm showing you a 40-year amortization option. The other ones I showed you do have 40-year, just time constraints do not permit showing every single configuration possible. But I did want you to show you here the 40-year option here. Now, the interesting thing on the 40-year is that once it does end the 10-year interest-only period, it then transitions to a 30-year amortization, fully amortizing loan, right? So that's the difference. Now, the 40-year does have a little bit of a higher price than the 30-year, again, because of the depth of the market offering 40-year versus 30-year. There's more 30-year options than 40-year options, also a little bit higher risk for the 40-year option, hence higher interest rates. 10.375 is our lowest cost option, and you can buy that down all the way to 9.5% for our 40-year amortization interest-only loan. That's a super low payment there. Now, let's go into some DSCR options for our final three examples here. Now, DSCR is our flagship program and the most popular investor financing program because, as Nick showed you just a minute ago in the rates, the DSCR rates are pretty much there competing with the full doc agency rates, even though we are using the gross rental income generated by the property to qualify the borrower. The debt service coverage ratio, which is what DSCR stands for, is calculated by dividing the gross rental income generated by the property divided by the total housing expense, principal, interest, tax, insurance, and if applicable, mortgage insurance and HOA fee. So in this scenario here, look at these rates. Now, remember, this is 40-year amortization. You're looking at 8.875 with a lender credit, and you can buy that down all the way to 7.75%. And this is for our 40-year amortization at a max of 80% LTV for the purchase. The 85% LTV DSCR option does not offer an interest-only feature. And now to show you the difference in the interest rate and basically the difference in the cost between the 30-year amortization and the 40-year amortization. Again, this is still interest only, but now look at that difference. Now let me pop over a minute to the other one here so you can see lowest cost option was 8.875 and you can buy it down to 7.75 versus this one you're looking at 8.125, so 0.625% lower, or actually 0.75% lower for the lender credit option, and you can buy that down all the way to 7%. So this is 80% purchase DSCR, 30-year interest only. That is amazing. And for our last option here, a nice interesting combination for an interest only DSCR cash out with a 40-year amortization. Wow, that's a tongue twister for all of the components of this loan. But what's even better, look at those rates. Wow. So you're looking at 8.5%, offering a little bit of a lender credit, and you can buy that down all the way to 7.5% for your 75% LTV, 40-year amortization, 75% LTV, DSCR, cash out refinance of your one-unit property. So definitely looking forward to helping you all structure your DSCR, your interest only, and any other non-QM, as well as agency loans that you may have for all our MLOs out there and our borrowers.
All right. Thank you, Jose. Looks like we have a couple questions here. First, let's get into Daisy's asking, is the monthly payment shown the IO for the first 10 years IO, or is it blended for the full 30 years? I think you went over that, but let's just real quick
Yes,
go over
sir.
how that works.
Yes, Daisy, that is we are showing the interest only payment and everything that we showed you. So, and remember, when it's interest only, amortization doesn't come into play yet as far as the payment. But do keep in mind that the 40-year amortization stretches out the term much more than the 30-year amortization. So eventually it will come into play once the loan becomes a fully amortizing loan. But in the beginning, for the first 10 years, it's interest only. The interest rate multiplied times the principal balance divided by 12, that's your payment.
All right. And one more question from Bill. On a DSCR loan, does the buyer need a renter in place to close the loan?
Well, I will tell you, Bill, that that's a subject matter that doesn't really pertain to the loan being interest only, but it does pertain to the guidelines of that particular product or option that we are selecting. So for purchases, they're never really going to require that a renter be in place because we're either going to use the market value from a 1007, which is the schedule of rents for an appraisal, or we're going to use a lease if there is already a tenant in place. For a refinance, that's where it gets a little tricky and where you have to delve into the guidelines for the option that you're selecting, because as you know, non-QM guidelines are all different. One conduit may say no worries if it's vacant. Others may say we won't refinance it if it's vacant. Others may say if it's vacant, we'll give you a haircut. In other words, there'll be a downward adjustment to the market rent off the 1007. Maybe they'll use 90%, tends to be common to use. So you do have to be careful on this. So if it is a vacant property and your borrower has identified that it's a vacant property, then make sure that the options that you send that buyer or borrower, if it's a refi, for example, do take that into consideration, right? You click into the guidelines, you review how those guidelines treat vacant properties on a rate and term and or a cash out refinance, and then handle it accordingly. So you would only present options to your borrower that would be applicable for their scenario.
All right, and we got some more questions coming in here. We got Melvin with the DSCR product. Market rate rent is usually determined by the appraisal or current lease. An environment where rents are declining, how does that factor in? Good question there. Kind of piggybacks on your other one.
Okay, that's interesting. We don't have any declining rental markets right now, as far as I'm aware. But if a market in general, let's talk about values and or rents. If a market has been identified as a declining market, then there may be an LTV adjustment is usually how they handle it. They're not going to discount your rent, but they may discount the loan to value. So be aware when you are pricing out your deals that the conduits do identify some markets that may be declining in value, and that's what may end up adjusting your LTV versus declining rent. I can't really recall I've ever seen an alert for a declining rental market, but I've definitely seen alerts, and there are a few alerts right now, believe it or not, in the United States where there are declining value markets, and those properties are then being adjusted downward by 5% to the LTV.
Good questions. So thanks everybody for the questions today. We'll give it one more second here. If anybody else has any other questions, but thank you, Jose. Those are definitely good ideas. Hopefully we don't see any markets declining here anytime soon, but good question for sure. All right,
So I just wanted to remind everybody what I touched on during the presentation, because this is the tricky part. That's why I'm emphasizing again. If you do need the interest only component to be taken into consideration to qualify your borrower, make sure that the guideline for the option that you've chosen or you're offering your borrower does allow that to be the case.
Because not all do. Of course, the payment will be interest only, but calculating the qualification on the interest only is the fine print to read, right? All right. Well, thank you, Jose. Thanks, everybody, for the questions. We will be back tomorrow. Oh, one more question from Jackie. What all of your demos were using the high credit, I'm assuming, right, Jose?
So. Yes, I was using maximum credit for all of these examples, which is 760 or above. Now, regarding what credit score you're looking for, I mean, it really depends what the objective of the customer is, because first we're going to start with asking the customer, what is your credit score, right? And then we're going to offer the customer the options that are currently available for that credit score. And then we're going to consult the customer, right? And I'm getting goosebumps here, right? Because this is where we differentiate ourselves from the application takers out there. And this is why our team is going to be able to compete in this market of, not meaning to be redundant, but a very competitive market that's out there, is because we're loan consultants. You're then going to discuss with your customer the possibility of you running a credit simulation once their credit report is pulled by you through our system. And then you're going to offer them advice based on the credit simulation of what they can do. So then you're obviously going to ask your customer if they may have a lower credit score, and which only allows them to get to, let's say, a 70% LTV. But the customer's objective, that's why you have to determine what are the objectives when you're starting out on this mission. If the customer's objective is 80 or 85%, then you're going to let them know what is the minimum credit score required to meet that objective. Then you're going to get into credit simulation and what you can offer once the credit is pulled. Hence, then they can do a TBD pre-approval. We do a soft pull tri-merge. You do a credit simulation, and hopefully within a month or two, they're in the position to meet their objective of 80 or 85%.
All right, and we had time for one more question to come in here. Michael's asking, can you do a cash out refi for interest only, or how's the math work?
Absolutely. Have you noted the cash out refi was the last example that I showed you? It works the same as any other loan. It's interest only. Interest rate times loan amount divided by 12. That's your payment. So it is. You can do interest only on any non-QM loan. The only limiting factor there is going to be, does the conduit that you're looking at offer interest only? But interest only is a possibility on every single non-QM loan configuration out there. 30 and 40 year.
Just not all of the outlets offer it, right? So we have every version of our product. So there's a 1099 that offers it. There's a bank statement that offers it, but not every bank statement offers it, right? So just make sure you, like Jose said, you look at the bank statement options and then select interest only, and you'll see a couple may not come back up and a couple will. So great info there. Couple comments. Thanks, Michael. Thanks, Melvin. Thank you for the good questions, guys. And let's go ahead and wrap it up. We will be back tomorrow, 11 a.m. Eastern, as we do every morning with Daily Rates Live with the Mortgage Calculator. And thank you, Jose, for the great examples. We'll see everybody tomorrow.
Have a great day, everybody.